Hello and welcome to India Market Open. It's a bright day, but of course it looks like there could be some more pressure coming on the street. Good morning, Agam. Very unexpected, the big fall. We were expecting HDFC to open weak yesterday, but this fall was exasperated. The markets declined 2%. This morning as well, implied Nifty indicating to another gap down opening for us.
So it always does happen, right? Whenever markets are at life highs, well, a lot of traders and perhaps participants need a trigger, and HDFC perhaps provided one, even though the numbers prima facie were not as bad as we were expecting them to be, Samina.
In fact, interesting, the brokerages don't seem very disappointed. Most have said that, in fact, the likes of the CLS have actually upgraded the target price on HDFC Bank. But we'll talk about that very shortly. It's a quick up. First up, if I can get GIFT Nifty, the implied open that we're expecting in trade this morning. It's another gap down morning. 200-point cut is what the Nifty implied open is. Unlikely we will see such a massive gap down, but nevertheless, that is what the street is picking up on this morning. In terms of global cues, very mixed. Asian markets are trading mixed. China trades at a 5-year low. Wall Street as well ended flat to slightly lower. Data points that came in from the US, so retail sale numbers is what we had, came in slightly better than expected at 0.6% for the month versus a 0.4% expectation. Remember, this reiterates the sentiment of consumers on the street is very resilient, once again putting doubts on the fact that the Fed may not cut rates as aggressively as the markets have priced in. On back of that, what you're seeing is Wall Street taking a bit of a breather and Asian markets also trading subdued. Worth the mention is that Europe saw a big fall along with us in yesterday's day of trade. So all your markets across the Eurozone, including the UK, had a big fall with cuts of about 1.5% to 2% in trade. Well, that's the global picture, but it's all about local cues this morning. We'll quickly set you up for what we're expecting in trade, and then Agam will take you through all the activity that we've seen in the future side and technical levels as well that will be crucial in today's day of trade. Well, just a quick recap of what happened yesterday. We started the day off weak around levels of 21,700, sustained around 21,800 for most part of the morning, but finally ended the day with a huge cut and trade at 21,571. A 2% decline is what we picked up on D Street. Well, Nifty is expected to see a gap down as indicated on the GIFT Nifty trade this morning. We also expect selling to continue for the broader markets, which have been expensive, and there has been talk about how that valuation actually needs to ease off. Bank Nifty could again be in a bit of a spot. HDFC ADR ended the day with a cut of 9% in overnight trade. If that's got to play out, you are expecting another 4 to 5% chop on HDFC Bank in the first few minutes of trade this morning. Metals as well may see some more selling on back of a stronger dollar index. FIIs have sold record figures. In fact, the highest amount of record selling by FIs in a day has been seen since 2017. So, Agam, every cue that we're getting in this morning is weak. FIs have been selling. HDFC ADR is lower. Global cues are looking weak. Implied Nifty is looking off to low start. I don't know what bulls are going to hold on to this morning. And let's not forget a much anticipated correction. And we talked about this at the start of Jan, how Jan usually is a tough month for the bulls on the street.
Right, Samina, in the morning we were talking about whether or not the markets would rise, would they fall, would they consolidate. That's an answer no one can give you at the moment. But what you can get from what we've seen in the past is, firstly, when you actually do see another gap up, that's usually followed by a little more selling, because a lot of the older positions will also get cut. Remember, we saw that sell figure of around 10,500 crores, and with that, well, on a net basis, January has become an FPI net sell month, and this is the first time we've seen something like that since the month of October. Moreover, in terms of the levels that we are watching out for as far as the Nifty is concerned, currently there is a complete shift in that range. So earlier we were in fact looking at building a base around 22,000 on the Nifty, and this was literally one session ago. That has completely changed, and now 21,800, 21,900 becomes an upper end for the Nifty. Remember, today is the Nifty weekly options expiry, so things are not going to be any simpler. There will be further cuts in positions, and if we do see that options, weekly options expiry play out, there could perhaps be a lot more volatility. That said, in terms of support, we're still keeping an eye on 21,000, 21,100. But the India Volatility Index has risen to the mark of 15, highest since mid-December. And the Nifty put-call ratio has now moved below the mark of 1 at 0.7. Is it completely oversold? Not really, because there have been instances in the past where we have seen that number go all the way to 0.5 as well. And of course, in terms of FII index futures too, they're still on a net basis long. So 54% longs against 46% shorts. Finally, a very quick look at the Nifty valuations. They still haven't come off substantially. Of course, with a 2% correction, you're not going to see that big move in any case. But for FY25, the number has gone below the mark of 20. Remember, the last 5-year average is 24 times. So it's not like we're anywhere close to the average either. Does that mean that we're going to see an upside on the Nifty? Well, that's a hard one to tell. But for now, this is how things are stacked up as far as technicals are concerned, Samina.
Just very quickly to add to those technicals, Agam, we've broken the 20-day moving average and closed below that in trade. Yeah. The last time this happened was on the 23rd of October, 2022. And historically, from what we believe, a close below your 20-day moving average, at least in the past, has led to the Nifty declining anywhere in the range of 5 to 10%. So that's another number you want to watch out for. 21448 is an important level of support. If that gets taken out, you will head all the way to the 50-day moving average, which stands at 21,167. So two important levels to watch out for: 21448, which may get taken out in the early hours of trade. But if we sustain around those levels for a longer period of time, you may be heading all the way down to 21,167. Bank Nifty, I think that's requires a little more of a conversation. Yeah. HDFC Bank, a heavyweight, led the decline on Bank Nifty. The contingent spread from HDFC Bank to the other private sector banks as well. So your ICICI Bank, Kotak Bank also saw selling pressure emerging. Of course, nowhere to the extent of a 9% fall that we saw, but iBank, Kotak were also down anywhere in the range of 2 to 4% each. As we set ourselves up for trade this morning, Bank Nifty also could be testing critical levels, which Agam will take you through. But worth the mention is that yield curves in the debt market, Agam, have inverted, which means that short-term yields are higher than the long-term ones, simply indicating that liquidity really is tight in the system. Yeah. Historically, of course, this number would freak people out because it didn't happen as often, and it could be a sign of a recession. We're not going that far to call it a recession. Absolutely, it's just tighter liquidity in the system, but definitely worth a mention. The rupee as well has been on the sell side. That's one more thing that you want to watch out for. But largely speaking, Baer's in control. The street will be driven by lots of cues coming in from earnings, and that will be stock-specific action. I'll quickly highlight a few stocks beyond HDFC Bank, and of course, Agam will jump in on all the other ones as well that we're watching out for. Happiest Minds, numbers reported largely in line, nothing really to write home about. The margins were flat, net profit came in flat. They've, of course, talked about investing heavily into technology. That's what Happiest Minds was about. Oracle Financial Services, they've posted numbers that have surprised the street. Margins have come up substantially on back of lower employee benefits that took place in this quarter. So from 85% last quarter, it was down to close to 70%. Higher revenue base, lower employee benefits have led to improved margins and operational efficiency for Oracle Financial. The stock could see some bit of a gain in early hours of trade. LTI Mindtree as well, no surprises, largely flat numbers in line with expectations. IIFL Finance, they've seen a big jump in fee income and commission. We will understand from the management when they address us later today at around midday to get a sense of what led to such a spike in interest income and fees and commission. But that's largely IIFL Finance. Alok numbers in line. Sun Pharma and Nazara are two other counters to watch out for, but I'll let you take those and then move on to HDFC Bank.
Right, absolutely. So as far as Sun Pharma is concerned, we understand that they are going to buy the remaining 21% stake in Taro, which is their subsidiary. This also means that Taro will be completely taken privately, and it will no longer trade on the New York Stock Exchange, and they are going to acquire this particular additional stake for about a little less than 2,900 crores. We have Adani Enterprises, which will also be in focus as it signs a memorandum of understanding with the Maharashtra government to set up a 1 gigawatt hyperscale data center, and they will invest up to 50,000 crores over the next 10 years. Standard disclaimer that the channel that you are watching is, a Adani Group entity. Moving on, we also have NHPC, government to sell as much as 3.5% stake in an OFS today and tomorrow, and this will be at a near 10% discount to yesterday's closing market price. And finally, we have Nazara, which will also be in focus even as it raises up to 250 odd crores via a preferential issue. So that perhaps could see some amount of traction going in today's day of trade, Samina.
I just want to quickly mention Polycab as well. They will be reporting earnings today, so keep that on your radar. They, remember, posted a spectacular quarter in quarter two. The numbers were on record levels. The stock for the 7th consecutive trading day has ended positive. It went home with gains of 2.5%, even on a day when the markets have actually seen a very, very sharp fall. But keep Polycab on the radar. Numbers are expected. I'll give you a quick expectation. So revenues are expected at 4,376 crores. EBITDA is expected at 600 odd crores. Margins are expected to improve at 13.8%, and PAT is expected close to 417 crores. It'll be interesting to see if the management talks to us and gives us any sorts of indication of everything else that's been happening, event-based for Polycab. But the big story is beyond stocks. It's about the markets, about the fall, about why HDFC is leading the way down and may continue to do so today as well. We, of course, got a conversation going with Kotak Mahindra's AMC head, Nilesh Shah, when we asked him about HDFC Bank's sharp fall in the market post its third quarter earnings announcement and effectively dragging the bank Nifty. This is what he had to say.
In the stock market, over-promise and under-delivery invariably gets punished. Under-promise and over-delivery invariably gets rewarded. For stocks as well as the market, we'll have to remember that we are trading at premium valuation to most peer group. There is expectations that our earnings growth will be superior and will deliver somewhere between 15 to 20% compounded profit growth as a market. Any undelivery over there, low delivery over there will have its consequences.
That's Nilesh sharing his views about what he made of those earnings from HDFC Bank and what, of course, he made about that big impact it had on Bank Nifty and the contingent fall that we saw across the markets. Rishi, I believe you have a little more dope on this one. The stocks got trashed yesterday. It continued to get trashed in overnight trade. This morning, the Nifty is GIFT Nifty is indicating to a gap down. Bank Nifty is going to look weak, and HDFC Bank may follow suit. But what is going on? Because brokerages don't seem disappointed too much. Yep. But the market is either getting ahead of itself or they're hugely disappointed and they don't see too much of an end to this.
I don't want to comment on the brokerages, but the way the numbers have come out, so there's a clear difference between the deposits and the advances on the portfolio. The loan deposit ratio at 110%. Now, what most people don't seem to realize is the gap between the deposits and the loans. Currently, loans are about 2.5 lakh crore higher than the deposits. And of course, you need deposits to fund any kind of loan growth at the bank. Accordingly, the liquidity coverage ratio for the bank is about 110%. The regulatory minimum is 100%. So it's not like there's a lot of free liquidity available on the balance sheet to be to continue that kind of lending. On the deposit front, the bank says, and this is something that the CFO Srinivasan Vaidyanathan said during the conference call, is that deposit growth needs to outpace credit growth by about 300 and 400 basis points. That is the only way that you can achieve a loan deposit ratio that is slightly more respectable at about 85%. For that to happen, you need to see significantly higher deposit accretion, which in the current environment is highly difficult because every other bank out there is looking for deposits. There's a liquidity shortage in the banking system, so everybody is chasing that deposit pie. In that framework, in that situation, all you can do is reduce the advances growth enough so that your deposit growth starts picking up about 300 to 400 basis points higher. Currently, the difference is over 200 bips. If you look at it sequentially, advances grew about 4.9%, while deposits rose about 1.9%. There's a straight up 300 basis point difference between the advances growth and deposit growth. So that needs to be reversed, and that's not looking like a definitive possibility or a short-term story. This looks like something that is going to pan out over time, because remember that the bank also has to replace the borrowings on its balance sheet with deposits so that it can bring down the cost of funds that it has. So that's where this entire situation is lying right now, Samina.
Very quickly, Rishi, is this also the case of going in with high expectations of the management? Of course, Sajid also has more on that, and and if you can tell us about that, is that what it is? Is that about the fact that post this merger, the commentary was such that the markets are feeling disappointed because of under-delivering maybe?
Well, slightly there was an overpromise problem. That is for sure, because from the beginning of this entire conversation, from the merger, the bank has been repeatedly saying that this is going to be an accretive sort of merger. They are capable of replacing high-cost borrowings with lower-cost deposits. They will open 1,500 branches every year so that they can get that deposit pie in. Those things, while they worked for the first year, the second year, those things have started to slow down, which is natural because it's a humongous merger, and the financials that we're talking about, the numbers that we're talking about are large. So while the market was expecting that the management can execute it, clearly there is a gap between that expectation and the reality that exists on the HDFC Bank book, and that's what's playing out in the stock markets.
Talking about HDFC Bank, they've also made an announcement that they're looking to open their first branch in Singapore. So I guess keeping up with their global plans, if not local expansion plans. Sajid, I believe you've got some in-depth on HDFC Bank.
Before that, I have a question for Rishi. Rishi, the bank has been talking about that they don't want to go into wholesale deposits, and the reason being that the interest rate cycle is about to turn. We heard yesterday Dinesh Khera talking about that the first cut may happen between October-December. That means that they're going to go slow for the entire fiscal FY25. And that also means that either they have to go for an equity raise or shore up their capital so that they can meet the guidance of the growth, right?
Yeah, I mean, ideally, yes, because the only way to fund that kind of growth, Sajid, is either through equity or through actual liquidity that is there in the banking system. Now, if the liquidity is going to be tight for the time being, we do not know what is going to happen before the financial year ends, because the budget is coming up next month. We may see higher government spending, because this is being an election year. You may see slightly higher government spending, which basically means that the system may get a liquidity boost. But that, at this point in time, is an uncertain future. The way the bank has been guiding to the future, it does seem that it's going to be a tough challenge to manage that liquidity base. And if that is going to be a question, then to fund that growth, you need the capital to come into the bank.
Right. That, of course, is largely what Rishi and Sajid have been discussing. Mr. Sajid, back to you on more on HDFC Bank. What are the positions? Why FI is selling this one? I guess you've got some more details of what's happening on the stock.
So let's take a look at the intensity of sale that happened yesterday, right, on HDFC Bank counter. The average traded volume or traded value was somewhere around 2,600 crores on a daily basis for the last 1 year. Now, on Jan 17th, we saw a total turnover of 13,000 crores, which is nearly 5 times the average daily traded turnover. Delivery was nearly 60%. If you put it into context for the entire Nifty Bank, because we saw good action coming in Nifty Bank there, Nifty Bank delivery total was nearly 10% of the total turnover of the market. Total turnover of the market between NSE and BSE was 1.4 lakh crores, and Nifty Bank itself had 14,800 crores of delivery, which across 12 banking stocks. That brings us to the big question of what was the kind of total delivery happening in some of the key stocks there. 8,400 crores of delivery happening on HDFC Bank alone. Nearly 1,800 in SSC Bank, and Axis had 1,200. All of them with high delivery percentages, and that's what we saw in the FI numbers that came in yesterday, provisional numbers, where the net sale was more than 10,000 odd crores. A large chunk of that coming from HDFC Bank, where 8,400 crores of delivery happened there. So why are FIs selling? The first thing is that the bank, it seems, has failed to guide the street on growth and the merger complications, basically, or the challenges which are coming in. It's not been clear in its communication to the street or to the brokerages or to the fund managers or to the institutions, and that is now playing out for the last couple of quarters. There is a sacrifice on growth and margin, which bank is talking about, which basically means that this bank is going to be derated from here on, and because the institutions were holding on to HDFC Bank despite the fact that there is a negative news or underperformance coming in the last couple of quarters. In the last 1 year, it has fallen by 6% compared to the index. It is basically primarily because they had consistent growth in terms of top line and bottom line and good margins. Now that is going to be a question mark for all the institutions going forward. Also, the final thing which I want to talk about is the HDFC Bank in the model portfolios of all funds. Whether or not it was performing or not, it was part of it. Now that there is issue in it, it's dragging the entire returns for the funds, and that's the reason why we saw some selling happening. If you look at the ADR premium, how it moved yesterday, it's come down, it become flat. It's almost, if you look at here, it's almost at 0.2%, which basically means that there has been a lot of selling in the ADR market. The premium was always because there was a scarcity and liquidity, in the US market. 13.5% of HDFC Bank's equity is in the form of ADRs in the US market, and there the premium has always been higher. Now it has fallen down to 0.2%, which is at par with the local share price. So there is going to be some pressure on HDFC Bank today itself, but whether it's going to be to the extent that we saw yesterday is going to be, it's a question mark here. The bank will see some kind of correction as we see in trade today because of the Nifty expiry there, but I don't think it's going to be to the extent that we saw yesterday.
Okay, Sajid, thanks so much for getting us those updates on HDFC Bank. Of course, a lot of details out there are unprecedented, as Sajid has already pointed out. The question really is, what do we do with this bank at the moment, provided in anticipation of perhaps a little more weakness in today's day of trade as well? We have Pranav Gundlapalle, the Senior Research Analyst at Bernstein, is joining us. Pranav, good morning and thanks for joining in. Well, firstly, your assessment of the numbers. We have gone through your note, and well, you weren't very, very pleased with the earnings. We understand that. But after the kind of correction that we saw yesterday, some more correction perhaps in store today as well. Where do you stand on this one? And well, what do you do with this?
See, I think, stepping back, if you look at the reason for disappointment, I think when the headline numbers came out a couple of weeks ago, I think the disappointment or the deposit numbers were not very healthy. Growth numbers were not healthy. But the expectation then was that this should ideally lead to an improvement in margins. And going into the quarter, the expectation was that the previous quarter was the bottom in terms of margin. And the NIM should gradually improve from here on over the next several quarters. Now, when the results came out a few days ago, you had a flat NIM. Despite the weak deposit growth, the excess liquidity being trimmed, and the ICRR drag also going away. So all the near-term drivers for NIM improvement were all consumed, but the NIM didn't move. So that was the biggest disappointment, number one. And number two, I think what was also not clear was the reason for the weak deposit growth. And if that was simply a reason or a way to maintain margins, or if it was being driven by other pressures, such as the need to maintain LCR ratios at certain levels, or in order to optimize for PSL requirements next year. So I think both a disappointment this quarter and not knowing the reason for it, and a lack of a clear trajectory to go on for NIM improvement from here on would be the key reasons for disappointment. Now how does what would that what would the worst case look like? See, the worst case here is where the deposit growth is constrained, and that leads to a slower loan growth and therefore the earnings growth. But for the reaction that we saw yesterday, almost a 8-9% decline, that almost factors in a year and a half of absolutely no earnings growth, which I think is quite extreme. So after the correction, I think it's it's probably overdone, and even for the worst case scenarios, I think it looks pretty attractively valued at this point in time.
Right, Pranav, this is Vishwanath here. I just wanted to get a sense from you. So they've guided 300 to 400 basis points of deposit growth higher than your advances growth. That's the only way to bring that LDR into a respectable range. Currently, the gap is already 300 bips, and if you want to outpace it by another 300 bips, that's an additional 600 basis points of deposit growth. What is a realistic number that you're looking at on the deposit growth front? Because you said that the stock correction yesterday assumed a year and a half of no earnings growth. So has that been factored in fully, or do you think it may take even longer than that?
Okay. See, I think on the deposit, well, there are two parts to this. I think one is there is the core retail deposit growth, which I think they are delivering, let's say, 3 to 4 percentage points easily over the system. They're getting incremental market share of 18-20%. Now, the second part is the wholesale deposits, which they actually trimmed down last quarter. And I think the challenge is if they are able to raise wholesale deposits, then they could get to easily about 4 to 5 percentage points over the system growth rates, right? So I think the question is, what is the constraint on raising more wholesale deposits? Is it simply the cost of funds, or is it actually the LCR constraints? Now, therefore, for a reversal of the LDR or the improvement in LDR, what now becomes important is the system deposit growth rate. So if the retail deposits are only going to grow at 3 to 4 percentage points over the system growth, and unless the system comes back to, let's say, 13-14% growth in deposits, it's going to be hard for them to get to something in the 20% range of deposit growth, which is required for that that 17% of loan growth. So at where we stand today, it is going to be a scenario where loan growth will be almost 3 percentage points lower than the deposit growth. And HDFC's deposit growth now appears to be a lot more dependent on the system deposit growth coming back rather than any self-help story that they have.
So then what does that do for the margins? Because that's the bigger question, right? I mean, 3.4%, they remain flat. But how much longer can they maintain that 3.4 if they're going to slow down on the loans and push up deposits or whatever, as the system pushes up deposits?
See, one of the two will happen. I don't think it's a case where both happen, right? So if you have a slowdown in loan growth, let's say 10%, right, and the deposits are going to grow at 13%, then what you will have is the margins will stay where they are, with in fact a slight improvement in margins, because you have more deposits coming in and replacing borrowings, right? So in that worst case scenario of loans slowing down to extremely low levels, you will have margin improvement. The other way around would be where they continue to push on loan growth, but then they increase the share of borrowings even further, push up LDR even higher, but that's probably going to lead to a hit on margins, which is probably not the route they will take. The more likely route is where they slow down the loan growth to the extent where it catches up or it matches deposit growth minus 3%. And that will lead to an automatic margin improvement, if not at least a stabilization.
Right. The last question from my front, and I wanted to ask you one point that the management had mentioned and caught my attention, where they said that the infrastructure bonds that they've taken on their book, about 7,500 crore during the quarter, that is slightly better than fixed deposits in terms of its nature. But then the cost question still remains. So I'm just trying to figure out what the logic behind that is.
See, I think the infrastructure bonds will be a tad more expensive than term deposits. So going that route will hit the net interest margins for sure. But where it helps is that it reduces the PSL requirements in the following year. and therefore the cost of meeting a potential shortfall next year will start to come off. So it's going to be worse off in the current period, but hopefully benefit the bank in the outer years, right? So I think that's the trade-off, and that's one reason. The second reason is also that the infrastructure bonds will be more favorable to the LCR ratios than raising, let's say, a wholesale deposits, which would have a greater runoff. So I think both these factors would probably were probably the reasons why there was a preference for the infrastructure bonds, but it doesn't help NIM in any way in the near term.
Pranav, completely take your point. The company has, the bank rather, has concerns. There is disappointment. We've seen market cap erosion as well yesterday, might see some today. At what price does HDFC Bank become valuable? Because at some stage, I'm assuming the risk reward will be in favor of HDFC Bank.
See, I think it's very attractively valued even today. I think the debate is simply that how long does it take for that whole re-rating story to play out, or that improvement to play out. I think what's changed with the results is that what was supposed to be a gradual journey starting from this quarter seems to be pushed out by several quarters, and two, appears to be less in the hands of the bank and more in the hands of what happens to system deposit growth. So I don't think the longer term thesis has really changed, and therefore for someone with a much longer outlook, I don't think this should change a lot of things. But it does change the timelines for that whole improvement story to play out.
Pranav, taking a cue from HDFC Bank's earnings, the disappointment, the reaction, we did see the sell-off spread across other private sector banks as well yesterday. Of course, nowhere close to the kind of fall HDFC Bank witnessed. But as we are going to see earnings rolling out from the other private bank majors, are you going back and moderating your expectations of what to expect from maybe a Kotak and Axis and ICICI Bank in that regard?
See, I think the big question would be on the NIMs, right? So I think with HDFC, there were two factors playing on the NIMs. One was the higher pricing of liquidity and the tightness of liquidity translating to higher price of deposits and general cost of funds. The second was HDFC's own issues in terms of LCR and PSL, etc. So I think the key question going into the weekend would be to see how much of an impact this tighter liquidity has had on ICICI. I think it would be hard to make a read across into ICICI or Axis simply based on HDFC because it has two different factors at work. And if we have a much sharper compression in NIMs, then yes, I mean, I think that will lead to a further or lowering of expectations on NIM. I think the street already expects a decline in NIM, but more gradual and more marginal. But a sharper decline will lead to lowering of expectation, especially with a potential rate cut at the end of the year. I think the expectations will start to temper down a bit more.
Pranav, it was fantastic chatting with you and understanding from you your view on HDFC Bank and the rest of the banking space. We'll hopefully catch you soon again. In the meantime, a quick check on GIFT Nifty and what are we expecting in today's opening. The last we checked, there was a 200-point cut. That's narrowed down to 170 points for now. So opening closer to levels of 21,420 cannot be ruled out. HDFC Bank will again be in focus. The ADR was down another 9%. So some pressure in early trade is what we're expecting. We'll take a break, but we'll come back. We'll put the focus on technicals, so stay tuned.
Welcome back to India Market Open, and we now take stock of how things have panned out yesterday in the futures and options space and potentially what we can expect going into today's day of trade. Let's start off by taking a look at what's happened in the index futures. Let's take a look at the Nifty. Now, a 2% cut coming through and a substantially deep gash as far as the index is concerned, but we saw unwinding in the index futures to the tune of around 9%. A lot of positions being taken off. Potentially, a lot of longs unwound yesterday. But when it comes to the Bank Nifty futures, the picture was completely different. Taking a knock of 4.25% yesterday, it was the biggest percentage fall since March of 2020 on the index, even as we saw a 20% increase in open interest towards fresh shorts. Does that mean we are likely to see some amount of profit taking in early trade? Well, that's a wait and watch, and we have no guarantees whatsoever as to where in what direction can this index go, considering we are already expecting further weakness to come through. That said, in terms of the options market, coming down to what happened yesterday, and this, of course, was not surprising. We saw a lot more writing around the higher level calls, and while the 22,000 is completely out of the picture, the 22,000 strike, where we're now starting to see a little more writing return to 21,700, 21,800, 21,900 calls. And on the put side, as you can see, well, traders at the moment are not really, enthused about selling any of that. So we don't have much traction there. Let's talk about the open interest distribution then. And for now, that OI max distribution for the call has shifted back from 22,000 to 21,800. And that perhaps could provide us with a little bit of support, resistance on the higher end, at least momentarily. And on the lower end, 21,500 has max OI for today's day of trade, but that's a weak one. And considering we are going to see the Nifty open below that mark anyway, well, that clearly is going to be taken out of the picture once again. Let's talk about the handful of stocks which were in focus. So we did have a whole load of private sector banks which saw a declines, HDFC Bank notwithstanding, which did see about 20% increase in open interest towards shorts. Kotak Mahindra Bank also falling, and we saw shorts building up in Asian Paints as well. Perhaps a little bit of reaction to earnings. Longs in ICICI Lombard and Oracle Financial Services, and among stocks which saw unwinding in trade. Well, we took a look at short covering in L&T Technologies and Metropolis. Sale, Chamal Fertilizers and Jindal Steel saw unwinding. But that said, what do we do with these benchmarks at the moment on what could potentially be another very challenging day? Well, we have Kunal Rambhia, who is joining us on the show right now to perhaps take us through what he makes of these markets and cues. Kunal, good morning, and thank you so much for joining in. Let's start with your assessment on the benchmarks. What would you do with the Nifty and the Bank Nifty, considering we are going to look at a big gap down? Do you think that some shorts could be covered, or can we expect more weakness through the course of the day?
Hi, morning, Agam. Thank you for having me on the show, and morning to all our viewers also. So if you look at the Nifty per se, it's been almost 15 trading sessions. Nifty made a sustainable bottom rather, I would say, at 21,450 mark, and that was almost tested 3 to 4 times. Certainly, we are witnessing a massive correction right now, which has been a very short and a speedy correction. But at the same time, I think till the time 21,450 is not taken out decisively on the Nifty, the trend remains intact, and one should definitely capture this correction as a buying opportunity. If I come to Bank Nifty, certainly the trend is intact since October 2022, and it's clearly making higher top, higher bottom formation. But now we are heading for that particular gap which we saw during the beginning of December due to state elections. I think the good support is placed at around 44,800 mark, where that gap actually emerged. So 44,800 is something to watch out as the support level. Till the time the indices are near to or above those particular 2 levels which we discussed, I think buy on dip can be a good strategy from long-term point of view.
Okay, a buy on dip from the long-term point of view. But let's talk about a handful of stock ideas then, Kunal. What's the first one on your radar?
So, Agam, first let's speak about Maruti. Now, this counter is in what we have seen is it's been a laggard in the entire market journey so far, and it's been 93 days. This counter has been in the sideways consolidation, and now a bit of selling pressure is also building up. So the strategy which I'm suggesting here is a simple Baer put spread strategy. It's a debit spread strategy. What are we supposed to do is to buy 10,000 strike put at the rate of 122.5, which is yesterday's closing. And if you look at the 9,700 strike price put, I think that's trading at around 48. So if we buy 10,000 put and we sell 9,700 put, the total cost of this strategy is going to be around 74.5. And the max profit which we're expecting is around 225.5 if this selling pressure builds up really big. But here, one need not to miss out on the whole cost, which is a strategy which is at around 74.5. I think one can keep the stop loss of around 50 points on the debit spread. So the max loss in this can be managed till 24.5 with a huge potential on the upside to say 225.5.
So an interesting spread coming here when it comes to, Maruti Suzuki. What we are looking at is a spread in which your max loss is a rupee and, your maximum profit stands at around 2 rupees. Of course, this is on an expectation that we could see an improvement in stock. But Kunal, coming down to TCS, I believe you have another strategy here as well.
Yeah, so I'm going a little aggressive on the TCS. Now, this strategy is going to be kind of a straddle, short straddle with a long futures because we have seen a massive uptrend. And if you look at the chart, it's clearly making higher top, higher bottom, even post the result announcement, right? So going long on the futures at 38.60 and with a short straddle with a strike price of 38.80. Now, the combined call and put premium of this is approximately 102. So what we do is we put a stop loss of this strategy if the futures fall below 38.20. So now the max loss in case of futures getting triggered out is 40 points. And by then, I think put might just increase, call might decrease, and approximate loss on that can be 20. So the max loss on this can be around 60 points. And if the strategy turns out to be perfect, and if the counter remains either sideways or positive, we can expect 3% returns in the next remaining 2 weeks of the expiry. So I think this can be a good strategy from long point of view. But yeah, it's an aggressive strategy.
Very, very interesting strategy there, combining futures along with a short straddle on the TCS, looking to play for an upside of as much as 3% as far as this specific play on futures and options is concerned, involving both, in fact. On that note, Kunal, would take a moment to thank you for taking us through your views as well as providing us with a handful of trading ideas. And with that, it's over to you, Samina.
Thank you for that, Agam. Those are, of course, trading ideas for our viewers and all the F&O activity that we bring to you every single day by Agam. We'll take a quick break, but just before that, a quick... some market opinion really coming in from Nilesh of Kotak Mahindra AMC, who talks about what brought the bull run to a halt, what the correction signifies, and what sectoral action is saying. Here's a slice of that conversation.
बड़े बड़े बुल रन में छोटा मोटा करेक्शन आता रहता है. We had a fantastic bull run in last few months, and clearly market was running little bit ahead of its fair value. The large caps, the mid caps, and the small caps all were trading above their historical averages. This is some sort of reality check. A silver lining among the dark cloud today, the mid cap index has actually fallen less than the large cap index. It shows that in select counter, people are still looking to buy on correction.
Yeah. Okay, so let me, before I go to the broader question, the trigger came from HDFC Bank. I know you may not be able to talk about specific, but that was a key trigger after the results. After the analyst call yesterday, there is this concern in the markets that HDFC Bank may not be able to keep up pace. But we all thought initially that, okay, that's part of the reaction, it's priced in, but suddenly the wave of selling that started in HDFC Bank and it spread to the rest of the bank index, especially Nifty Bank, and by the end of the day we saw that almost 9% down as far as HDFC Bank is concerned. How do you look at this?
So Murli, as you mentioned correctly, we can't make stock-specific comment. But clearly, if you are Virat Kohli or Rohit Sharma, there is expectations that you will be hitting centuries. There is expectations that you will dominate the bowler. in the stock market, over-promise and under-delivery invariably gets punished. Under-promise and over-delivery invariably gets rewarded. For stocks as well as the market, we'll have to remember that we are trading at premium valuation to most peer group. There is expectations that our earnings growth will be superior and will deliver somewhere between 15 to 20% compounded profit growth as a market. Any undelivery over there, low delivery over there will have its consequences.
Right. So what happened today looks like the World Cup final, We all built up a lot of expectations and we know what happened at the World Cup final. Now, apart from cricket analogy, I want to look at what else is happening in the financial system, financial markets. Somewhere I also get the sense that there is a lot of money. There are excesses in the system that have taken place. The kind of oversubscription in the IPOs, the kind of leveraging that has happened, and the RBI had to step in and tighten. Now, do you think that the market is coming to terms with the measures that the RBI has taken and the SEBI's watchful eyes, that the leverage is becoming expensive and therefore people are cutting back?
So undoubtedly, without guardrail, it's difficult to play a bowling game. Your ball will go into any lane. It is the regulator's guardrail which keeps economy and market on the right track. And we have seen SEBI has taken several steps to ensure that our markets become fairly solid from a margin and settlement point of view. Despite large volumes in options and futures, the margining system by and large has worked fantastically well. There's no reason for disappointment. The leverage for the system is now coming more and more through derivatives. Some of it is inherent and may not be even acknowledged by people who are using that. But a large part of derivative position is used by informed investors, albeit driven more by non-institutional investors. So I will say that the correction in the market is probably a function of the run-up which we witnessed in last few months. From a payment margin leverage point of view, market looks fairly solid. The systems are working.
Well, that's Nilesh sharing his view on the big fall of HDFC Bank and, of course, what that signifies for the markets as whole. A quick check on GIFT Nifty before we move on to our conversation with our guest. Remember, it was looking far worse, actually. Literally 45 minutes ago, the gap down was 200 points, now at about 167. So as we get closer to a pre-open trade, GIFT Nifty's fall is looking slightly better than it did about an hour ago. Well, Shrikant, Chouhan, Executive VP and Head Equity Research at Kotak Securities joins in as well. Shrikant, good morning. How do you feel about the markets? I mean, we talked about a fall yesterday. There was anticipation, at least in the first few hours of trade, that if 21,850 would be held out. Now, that's not happened. It's the very first time since the 23rd of October we've closed below our 20-day moving average. And historically, whenever that happens, the markets have fallen in the range of 5 to 10%. If we get a start around 21,500, would you be brave enough to go short on the index?
Yeah, good morning. I think, see, what you're saying is right, that whenever the market breaks the important level, it comes down further. But the way the market has fallen in just last 2 days, and if we go through with the option statistics and the fall in a very short period of time, I think between 21,500 to 400, we should look for adding some long position. In fact, we should look for taking some contra bets close to 21,400. The reason is because the broader trend of the market is still very strong. Until the markets are not closing below the swing lowest level of 21,400, we are expecting market to remain in a broader range of 21,400 and maybe 22,000 on the higher side. So based on the put call ratio, based on the option statistics and retracement, We are of the view that we should look for adding or taking some contra bets close to 21,400. We can expect some rebound, maybe up to 21,700 or 800, which is decent in the current environment. Also, if we go through with the private banks, then they will also turn oversold in the near term, along with Bank Nifty. So the strategy should be to look for adding position instead of going short below 21,500.
Right, below 21,500, but Shrikant betting and hoping that there could be a rebound, a small rebound at least at these levels. Sunny Agarwal, Head of Fundamental Equity Research at Sbicap Securities, joins in. Sunny, I'll talk to you about the broader markets in a minute, but what's the view on HDFC Bank? It fell 9% yesterday. In overnight trade on Wall Street as well, there was a sharp fall. Selling is expected to continue. At what price would you be a braveheart and buy HDFC Bank? How much more from here?
Yeah, good morning. Thanks for having me on the show. First of all, I would like to highlight one point that the price at which yesterday HDFC ADR has closed, and if you convert that into Indian rupee, right now that clearly shows that the premium which was which ADR was commanding, that may shrink a bit. And if I convert that into Indian rupee, I feel ideally the stock should open kind of flattish as far as HDFC Bank is concerned. So there are two possibilities. Either premium vanishes completely and we may see kind of flattish opening today, or there may be a shrinkage of premium of HDFC ADR as compared to HDFC Bank share. So to that extent, the gap down opening may not be to the tune of 8 to 9% in HDFC Bank. Maybe 2-3% is the gap down we may see. So let us see where does it settle. However, in terms of valuation, definitely post this correction, if somebody has got a slightly longer horizon, medium to long-term horizon, then it's a good opportunity to accumulate HDFC Bank in a long-term portfolio. The approach can be obviously a gradual deployment of the capital rather than deploying entire capital at one go. SIP route is the best way where one can deploy his or her capital over the period of next 3 to 6 months in HDFC Bank.
All right, Sunny. Well, that's the street view as far as HDFC Bank is concerned. But we have some exclusive details from our sources, and we get to understand, get more insight as to what could have gone wrong with the bank. And we have a colleague, Muralidhar Swaminathan, who's also joining us to give us more insights in there. Murali, thanks for joining in. What else do we have?
Okay, I spoke to some very senior sources in the industry. The most important problem now is not with the bank, but with the communication. Right. So the guidance given by the bank management has not addressed the investor expectation. So there is a big gap between the two. So what's happened, they focused, in fact, the market has been focusing on the net interest margin. NIMS is the focus of the market. But the bank should have clearly addressed this issue and said that this is a short-term problem, and the focus should be on return on equity. Now, what went wrong? Over the last 1.5 to 2 years, we all know that the cost of funds have been going up dramatically. Liquidity is tightened. Depositors are moving in and out of the banking system because they find returns much better elsewhere. So now this is a transition. It's actually a transitionary phase. For a bank like HDFC Bank, they should clearly articulate to the investors. They should come out and talk to the investors even today. In fact, the source also pointed out that the management should immediately come out and talk to the investors, allay their fears, and say that the focus is not on NIM. Because if you focus on NIM, then the long-term stability of the bank will be hit. Because we are coming to the end of the interest rate hike cycle. It's a matter of few quarters, maybe mid-June or maybe October, the rate cycle could turn, not only globally, but in India too. So that is the biggest problem of communication. Management should have very clearly guided and said that, look, this is a short-term problem, and that they should have built in over the last few quarters and navigate.
So fair to say, Murali, that after the merger, expectations were anyway muted.
Right.
Management, of course, in some ways had overcommitted, maybe talked about a timeline that was a little far-fetched, A, and B, so would we then say that the problem is the management as opposed to the business itself, because the business, what it's going through may be an industry phenomenon at this point?
Yeah, no, so there are two factors to this. One is, as you said, the merger. The merger itself, there is a certain timeline to it, but the timeline is a process.
Yeah.
What's happening in the rest of the economy is something that has not been factored in, which is the cost of funds. When your cost of funds goes for haywire, there is a certain level of overconfidence. I will not say overpromise. That overconfidence was there, and that was built in. See, HDFC Bank, we all know, we trust the bank over the last 15, 20 years. Everybody knows that every year they will deliver. Now,
it was called the 30% bank for the longest time during Puri's reign.
So even now, what my source told me is that there is no problem with the bank itself. The growth is fine, but it's a short term. It's a transition. Now that communication has to go, and he suggested that the bank should come out immediately, and address this to stem the
decline. In fact, that's what we've been talking about as well. At some price, HDFC does become valuable, right? The risk reward will be in favor of the bank. At what point is anybody's guess. But thank you, Muralidharan, for that. We'll take a quick break. We'll come back. We're expecting a weak start, but not as weak as we thought it would be at 8 a.m. this morning, so stay tuned. Welcome back. You're watching India Market Open. It's expected to be a negative start. 150 to 160 point gap down is what we're expecting on the Nifty as we gear up for trade this morning. Asian cues are negative. The dollar rupee as well is expected to see some weakness from the get-go at 9 a.m. Well, Shrikant, we talked to you about Nifty. What's the trade on Bank Nifty? What is the trading range? What would you do if you get a gap down on Bank Nifty this morning?
Yeah, I think, for Bank Nifty, if we see the overall pattern, then it has broken the crucial important support level, which was around 46,900. And it closed below the same. But at the same time, if we see the entire pattern of the Bank Nifty, then based on its current setup, it is heading to the extreme oversold conditions. At the same time, it is heading towards the 50% retracement of the entire rally. Which most of the time acts as major support for the market for that particular index, as well as reversal point. So the strategy should be to look for adding positions close to 45,300, 400 levels. We can again expect rebound because it is down deeply from the highs of 48,000 to almost 45,000. So close to 45,300 levels, we should look for adding positions with a stop loss close to 45,000. And specifically for HDFC Bank, I think it is into that corrective pattern, and 1430, 1440 should be the level where we should look for adding some positions, because again, here also we will see some oversold activity, and I think 1400 is the area where we should look for adding if there is a medium to long term view.
We've got 39 seconds to go as we're gearing up this morning. It's looking rough, and that's probably the most polite way of putting it out there. Sunny, we'll come to you in a minute to get a broader view on the markets and the largest earnings season at whole. But in the interim, the Nifty is expected to see a gap down. Remember, we sold off over 2% in trade yesterday. Highest level of selling seen by the FIIs. We closed for the very first time below our 20-day moving average since the 23rd of October. HDFC Bank led the losses, lost about 1 lakh crores of market cap in one single trading day. Well, it is what we're gearing up for. 21,571 is where we closed trade. This morning as well, it looks like 21,000 this is all over the place. It's indicating to a positive start. It's not going to play out like that. Well, a 100-point up move on the Nifty is not an option this morning. A quick check on HDFC Bank before I let go over to Sunny and Shrikant to continue our conversation. There you go. The Nifty is settling. If I can just get HDFC Bank, it'd be useful to see what we're expecting on the bank in early trade. That's the actually, you know what? It's not looking as bad as the ADR was indicating. To a 1% cut is what we have. Sunny, is this an option? A view on the markets very quickly before I take a technical check from Shrikant. But how do you feel about the markets at these levels? Would you advise investors to participate, or staying on the sidelines as we go through the earnings season is probably a better thing to do at this stage?
Yeah, what I feel is that right now markets and opportunities are definitely there in terms of wealth creation. So one need to be stock specific and be on the right side of market. So obviously in terms of fraud, there are few pockets of the market like small cap, micro cap, where the valuations have gone through roof. So it's better to stick to the large cap or decent sized, mid-sized companies, and we focus on the companies where there is a bottom-up growth story. So few sectors which we like from a short to medium-term perspective are auto ancillary sector. That is a sector where we feel that the earning growth will continue, and still there is a money-making opportunity in some of the underperformers like Maruti, or for that matter, Ashok Leyland, as far as commercial vehicle space is concerned, or for that matter, Force Motors, where we are seeing a decent volume growth number. Then moving on to the capex, where government is right now focusing on. So few sectors like defense, railways, infrastructure. There are certain companies where there is still a money-making opportunity. So on infrastructure side, companies like Nagarjuna Construction, ITD Cementation, J. Kumar, Vishnu Prakash, all these companies can be looked upon from a short to medium-term perspective. In terms of railway, so we like both private as well as public sector companies. So among the private companies, one can look at Texail, Titagarh Rail, Jupiter Wagon, and on the public sector side, RVNL is a company where we see a decent earning visibility in terms of growth. On defense side, shipping is a space to be in. What I feel is that companies like Cochin, GRSC can be on radar. Obviously, we have seen a decent rally in Cochin shipyard during the last 3-4 trading session. So buy on dip is advised in shipping counters also. In addition to that, few NBFCs which are reporting a decent set of numbers. So for a case in point, yesterday IIFL Finance have reported a strong set of numbers. And so NBFCs which are focusing on housing finance and gold loan can be on radar. So companies like IIFL Finance, Manappuram, Muthoot can also be looked upon from short to medium term perspective.
All right. Well, Shrikant, coming back to you on some of the other pockets which are also buzzing in trade of late, and this is the oil and gas space. Maybe if you can take a look at something like a BPCL, an IOCL, or something like that. How are you seeing trends, and do you think that this particular pocket could perhaps buck the trend over the course of the next few days?
Yeah, I think this particular space is turning more and more interesting. The way there is a price pattern and the way they are sustaining whenever there is a weakness in the market or sell-off in the market, we see some specific buying interest in this particular sector and most of the stocks. So while looking at the technical pattern of BPCL and IOC, I am of the view that in the near term, we are going to see at least 5 to 7% sort of rally from current levels. BPCL, especially around 470.75, IOC, which is around 140 levels, is also looks attractive if it comes back to the levels of 135. But I think the specific trend is definitely there in these companies, and if there is any correction, then we should be buyer. We also like Gas Authority, GAIL, which is around 160 levels, and it is trading above its all important levels. So the technical pattern is indicating us that it is heading for at least 190.95. So broadly, I think this particular space should be on the watch list.
Shrikant, any other stocks you want to add to your list of top trades this morning?
Yeah, we like BHEL, Bharat Heavy Electricals, based on its technical formation. It is consistently holding above the levels of 200, which is positive. And even if we go through with the volume and delivery pattern of last 15-20 days, then we are seeing a good amount of surge in volume as well as deliveries. Based on its technical formation, we are expecting stock to move towards at least 215 and maybe 225, 230 in the near term. We also like ICICI Bank, and it was like down yesterday. But again, if we see any further more correction in today's date, and if it falls to 960, 955 levels, then it will be a very attractive bait with a short-term as well as medium-term view. So close to 950, 960 levels, ICICI Bank looks good to buy, and BHEL is also a stock to buy and hold.
All right. Well, we also had earnings from the general insurance companies. Of course, in this case, I'm talking about ICICI Lombard. There's some hits and misses, more misses than hits. Sunny, how are you evaluating this sector? And if whether or not do you, in fact, have a view on ICICI Lombard as well?
Yeah, so what I feel is that overall commentary from ICICI Lombard post results were positive, and one of the key important parameter which we track is combined ratio, where the company is very confident of improving the combined ratio over the next 4 to 8 quarters. So we continue to remain bullish as far as general insurance space is concerned, and ICICI Lombard being the market leader in the private sector space. So overall, the opportunity is pretty large as far as penetration of general insurance business is concerned, especially post-COVID. I think the general awareness of having a health insurance is something which is supporting this general insurance business, and at the same time, the compulsion from a regulator to have an insurance as far as motor business is concerned. So whether it is two-wheeler or four-wheeler or any vehicle, one need to have an insurance third party as well as own insurance, and that is leading to that is the kind of tailwind which is acting for the motor business also. So we continue to remain bullish on general insurance business and ICICI Lombard from a medium to long term.
A quick check on how pre-open is playing out. It's now sort of settling and indicating to a gap down start. 21,400 is what we are working with. Not as bad as what the GIFT Nifty was indicating to, but still a negative start is what we're looking at. Good chance that we will see a sharp cut in early hours of trade, spend some time consolidating, and hopefully may see some buying emerging in the second half of trade. Remember, brokers have consistently maintained and brokerages have maintained that India continues to be a buy on dips market. Now, how you quantify that dip is, of course, anybody's guess. Shrikant, quick take on metal stocks after banks. Metals were the other big losing space in trade yesterday. This morning as well, those stocks aren't looking as disturbed, if I may say. Any metal names that you would trade on today?
Yeah, because of this hawkish statement, I think yesterday we saw sell-off in global markets as well as on the metal index. And because of that, we are seeing some sell-off in our markets also. But otherwise, if we see the entire this particular space, then if there is any correction, then we should be buyer. In fact, Tata Steel, which was around 137, 138 levels, is now around 130. But if there is a very short-term view, then stay away because we can see further more correction. But if there is a medium to long-term view, then we should look for adding stocks like Tata Steel as well as Hindalco to our positional portfolio. But apart from that, I think these metals and mining stocks should also be on the watch list, but on correction, on dips.
Right. Sunny, a couple of earnings from the information technology space as well. LTI Mindtree, at least in the large cap, slightly better earnings, but I reckon there's some disappointment when it comes to margins. And Happiest Mind, on the other hand, subdued quarter, but in line with expectations. Your analysis on both these counters?
First LTI Mindtree post result con call, so there was a negative surprise in terms of commentary from LTI Mindtree, which was totally opposite of the commentary what we are listening from Infosys or TCS or large peers. So LTI Mindtree has went on record to say that the demand environment is still not very healthy and they are not confident of any significant deal wins, or maybe the environment is not so good. And to that extent, despite of having a slightly muted number, we may see adverse reaction as far as stock price is concerned. So maybe a gap down opening on LTI Mindtree. And as far as Happiest Mind is concerned, what I feel is that the company has reported inline set of number. Again, in terms of stock price, the stock is trading close to its fair value band. However, having said that, since their focus is on new age businesses, whether it is AI or cloud or any you talk of any new age businesses, Happiest Mind has got a majority share over there. So if somebody has got a slightly longer investment horizon, then Happiest Mind or mid-sized IT companies is the place to be in.
Shrikant, have you been tracking Polycab after that big fall? Clarification from the management. The stock has crawled its way back up in the last few days. Today, of course, we've also got earnings that they will be reporting. At 4,460, what is the trade on Polycab? It is expected to see actually a positive start this morning too.
Yeah, see, like for Polycab, we are of the view that it is rebounding after hitting the oversold levels. In fact, when there was specific news flow, the stock was down with a gap. And today, or maybe even I can say on Wednesday, when there was recovery, it closed above the level of 4,400, which is positive with a very short-term view. So we may see further more pullback in the stock. We are not expecting any major rally from current levels, but yes, we can see some pullback, at least up to 4,600 or 4,650, which is still 4-5% from current levels. At the same time, if you go through with the volume pattern, then on the day of news flow, the huge volume were there, which indicates that till the stock is not breaking back the level of 3,800, we are going to see some consolidation between the range of maybe 4,600 on the higher side and 4,000, 4,100 on the downside. So today, if we see any rebound close to 4,600 levels, we should look for reducing some positions with a view that the stock may consolidate and it will again come back to the levels of 4,000.
Sunny, do you track Polycab? I mean, they've had a fantastic second quarter. Of course, a few weeks ago, there was event-based news about the IT rates. Management has provided some clarification, but I think that overhang will stay with the company for a while to come. At this juncture, again, expectations running high on earnings. The stock has been seeing some buying. Do you think Polycab is a stock you would add to your portfolio from more of a medium to long-term time horizon?
Yeah, definitely. I mean, if I keep that IT case aside, I think the company is on very strong footing. So right now, the company is doing a turnover of 16,000 crore. And prior to this IT case, the company has clearly given guidance that they will hit a 20,000 crore top line by FY26. So that's a pretty robust growth visibility and the plan which the company has laid out. And in terms of valuation, also at 4,000 rupees from where the stock has bottomed out, the company was trading at a decent price to earning multiple of 30 times. And that has shrink from highs of maybe 40-45 times, north of 40 price to earning multiple. So in terms of valuation, definitely there is a comfort. But obviously, post this result, I mean, the street will be focusing on communicating with management that what is happening on IT case and how much is the liability which the company need to bear. And at the same time, whether the premium pertaining to the corporate governance, whether that will shrink or there is no tax liability, because there is still Polycab is under denial mode that we have not received any notice from IT department, and so we are waiting from action from IT department also. So I think there is still a clarity which is just to emerge on IT front. But if somebody is a medium to long-term investor, he can gradually accumulate polycap. Maybe a portfolio allocation can be slightly lesser, 1 or 2% as of now. And as and when the clarity emerges, then one can accordingly act. Once there is a clarity, one can increase his or her allocation in a polycap, the polycap. Or in case there is no clarity, or if you feel that, if one feel that the impact of IT can be adverse on polycap, then one can exit the position at that point of time.
Right. Sunny, stay with us, and Shrikant will come right back to you. Pre-open indicates to a negative start on D Street, but the big loser, which we're expecting, is not going to be HDFC Bank from the look of it in pre-open. It's LTI Mindtree. Pre-open indicating to a massive gap down. HDFC also expected to open below levels of 1500, but the index itself will be watching up for key levels. On the downside, 21,400 is what you want to watch out for. Upside, of course, the resistance is extensive there as well. Bank Nifty will be in focus, and a whole bunch of other earnings is something that the street will be keenly watching out for, and any sort of commentary that will be coming in for the players. It's not as bad as we were pricing in early this morning. 21,440 is what we've opened up at, 127 points lower. There's a very good chance that we will consolidate around these levels and see some buying emerging as we go along the day. After a 2% cut yesterday, the Nifty itself trading comfortably about 21,400 for now at least. Bank Nifty is still leading the way up. I shudder to think what's happening to HDFC Bank, but 45,525, a massive cut on Bank Nifty, a 512 point cut on Nifty Bank is what we are seeing. Broader markets looking fairly well placed. It's actually a very, very corollary of sorts, right? Your mid-cap is not doing as badly, and we've seen outperformance in the broader markets. Even though there are valuation concerns of the broader market, it is the broader market that's actually doing better than the frontline names in trade this morning. Let's take a look at the breadth and take a look at the big movers and shakers in the Nifty 50. The breadth of the market very likely is bad. Your biggest loser, like I said, was LTI Mindtree, and that stock is seeing a huge cut on back of numbers that were largely in line with what the street was expecting. The stock is off by 10%. HDFC Bank, as we indicated to you earlier, is not doing as badly as the ADR. It is sub 1500. There is some level of buying that could potentially emerge as it trades around levels of 1500. Remember, that is a level that's been sacrosanct for HDFC for quite some time. We haven't seen a run up on that counter, so the sell-off for now is looking overdone. 3% low on HDFC Bank, nowhere close to the kind of fall the ADR witnessed in overnight trade. LTI Mindtree is looking bad, 9.5% cut. Power Grid is seeing a 4% cut. Asian Paints numbers, the street doesn't seem pleased. Let's just put it like that, right? Numbers weren't too bad. Brokerages aren't too disappointed. The stock reported before market close yesterday was lower, and it continues to see selling pressure today as well. A big cut there, 5.5% being knocked out off a Nifty heavyweight is worrisome to say the least. Well, you've got the other financial names that are doing badly, but I mean the losses, the 150 point cut that you're seeing on the index is largely being driven by HDFC Bank, Asian Paints, Power Grid and LTI Mindtree. On the upside, I could mention a few names. You've got a little bit of defensive play happening. So Apollo Hospitals not looking too bad. Metals are seeing a little bit of a recovery, but nothing really to write home about. RI looks okay. Tata Motors and OMCs generally are looking comfortable this morning. Agam, it's interesting. Broader markets, where there are valuation concerns, are still continuing to do better than the benchmark. Yeah. HDFC is not the one leading the losses this morning. It is LTI Mindtree. In-line numbers, no big disappointment, but the street seems very disappointed for some reason. Yeah, certainly. And it's a little bit of a contagion effect as far as your information technology space is concerned. But I'm going to very quickly address what's happening in the broader markets. Let's start off with the earnings. We have Happiest Minds as well, where we have seen some weakness. Now, while the earnings were largely in line with expectations, we're looking at that kind of reaction. But Oracle Financial Services, on the other hand, looking at a whopping 10% up move. Locked in an upper circuit immediately on open. So that's as far as earnings around those technology companies are concerned. We move on and address what's happening with something like an IIFL Finance, which is down by around 2.5%, but ICICI Prudential
a lot of misses when it comes to the VNB aspect. The new business aspect perhaps is which is weighing down on the business, considering we saw such a sharp drop on a year-on-year basis. And well, that's also in fact nearly locked in a 10% lower circuit. We're going to have to wait and watch whether or not there could be some more selling coming through, potentially some more in store there as well. Let's move on and talk about things which are beyond earnings. So we have Nazara Tech, where we have a preferential issue. That's up around 1.3%. NHBC, on the other hand, is declined by around 4.9%. But remember, this is on account of an OFS, where the OFS is happening at around 66 rupees per share, where the government is looking to sell about 3.5% stake. So still not there. But of course, because of the fact that it's at a 10% discount, we're naturally expecting the stock to also come off to a certain extent. And Zaggle, on the other hand, of course, this is a news update here on expansion in business. So we have an up move around 3% there as well. This is as far as some of the other stocks in news are concerned. And ahead of earnings, we're keeping an eye on Polycab. The short covering continues, and now it has moved above the mark of 4,500 rupees per share. And Poonawalla FinCorp, on the other hand, under a tad bit of pressure, not as nervous as a whole list of other companies from the NBFC space, but a decline all the same. And besides these two, we're also watching out for Metro Brands, which is also nervous ahead of its earnings. And of course, India Mart Intermesh, which is actually flattish at the moment ahead of quarterly earnings. So a lot of companies from the mid-cap space as well announcing earnings, and a lot to keep an eye on, Samina.
It is, and it's interesting. Some of the reactions are just looking like they're overdone, but like Agam highlighted, ICICI Prudential, now those numbers were a disappointment. The stock is getting beaten down pretty badly. If you just quickly take you through what went wrong for ICICI Pru, the numbers were weak. They missed on all parameters. AP growth has only come in at 5%. Value of new business is down 29% year on year. There's been very big margin erosion. Margin erosion could be due to increase in ULIP share, and VNB margins are also down to 22.8%. This is what we've seen, and because of that, the stock is getting beaten down. 10% cut on ICICI Pru. Alok Industries, disappointing numbers, I guess. We don't have too much in terms of commentary, but the counter is reacting negatively. It's down 6.5%. But let's not forget that the early part of this month, Alok Industry was your top gainer. So it's ran up so substantially. And what you're now seeing is probably some profits getting taken off the table. NHBC is looking weak on back of news around the OFC. You've also got Ipca Labs down 2.5%. Fertilizer counters are weak. Asian Paints numbers have seemed to have disappointed the street, but on back of that, even the other paint companies are doing badly. So the likes of a Berger Paint are trading with a cut of 2 to 2.5%. On the gaining side, Agam has already mentioned how well Oracle is doing. It's up 10%. Aarti Industries on back of that order win is up 7.5%. Cochin Shipyard, now this is again a big order win. The stock was up yesterday, continues to do very well today as well, about 3.5 to 4% higher. You've also got Vaibhav Global, interestingly, doing quite well today. Remember, you've got marquee investors like Malabar Investments who are actually quite optimistic on this one since a few years now. That counter playing catch up. But largely speaking, it's not a great looking market, but the fact remains it's not as bad. There is some sanity returning to the street. It's down, but it's only down 0.5%, and I'm taking heart from that. Shrikant, would you agree? Do you think we've opened negative? We might spend some time deciding the fate, consolidate, and the second half of trade could actually turn out to be positive. I mean, at 21,455, we are pretty much at the day's high point.
Yeah, absolutely. I think the way the market opened and now it is like rebounding from the lows. See, these are the crucial levels, and we like most of the time we see some consolidation or some like sideways sort of activity whenever the market falls to the important levels. But eventually, the way there is oversold activity, we are expecting market to rebound furthermore. At the same time, Bank Nifty, which was around some 45,400 levels, 350 levels from there, now it is at 45,750, 700. So yes, what you're saying is right. I think even though there is like a sluggish sort of opening, we are now consolidating at important levels. And in the second half, we are expecting rebound from lower levels.
Okay, Sunny, a quick view on the paint companies. We had earnings from Asian Paints, but it seems like the reaction is a little more stronger today. With respect to keeping in mind Berger Paints, how are you placed on both these counters?
What I feel is that, Asian Paint number were, pretty decent number. 12% volume growth, benefit on margin because of correction in the throughput prices, input prices. Only the issue is on valuation front. So what I feel is that, what I can see from Asian Paint is that the industry is likely to do well, and at the same time, the company has went on record to say that the momentum will sustain in the fourth quarter also. So volume growth is something which company is seeing, and being an industry leader, I feel that the same will continue for other players also. And obviously, in terms of valuation, yes, we like the Berger Paints and Kansai Nerolac, both these businesses where relatively valuations are subdued, and one can look at those businesses also.
Right. Thank you, Shrikant. Thank you, Sunny. It's great having both of you today talking us through the markets. It's looking weak on the street, but not as weak as expected. HDFC Bank, if I can quickly pull that up, and I want to see if it's finding support around levels of 1,500. And it is, what a relief for retail investors who participated in the stock. Buying clearly emerging at that level. In fact, Agam, don't you think it's not looking too bad? I think 1,500 was sacrosanct for HDFC Bank, and it's pulling back quite well. So 25-point cut on the stock. Again, with this one too, you cannot rule out the stock going home with a little bit of gains towards close. Of course, like I said, there's a chance of that happening if we can't be sticking our neck out yet and saying that. Well, thank you, gentlemen. But we have with us a special guest now, Nitin Raheja, Executive Director and Head of Discretionary Equities at Julius Baer India, joining. Morning, Nitin. Thanks a ton for joining in. Nitin, it's interesting. We went into last year with such low expectations. The world was all gloom. There was geopolitical stress, a recession in the US. To make things worse, China was a problem. But we came out with shining numbers, to say the least. Our markets rallied up, made new record highs. It's quite a corollary from what we're entering 2024 with. Now we have good earnings, good flows, DIA participation, political stability. In that context, we've also seen the markets fall very sharply yesterday. What are you making of it? Do you think it's going to be a little tricky at this stage, given how stretched valuations are?
Look, I think clearly when you look at all the parameters from a fundamental perspective, right, it seems to be looking good from an India story perspective, right? You have liquidity flows being very strong. You have GDP growth numbers looking good. The twin balance sheet problem has been addressed. But I think the only headwind, and that's something which has been a concern in our conversations with global investors, has been Indian market valuations. The valuations actually today, in the short term, leave very little margin of safety as far as stock prices are concerned. More so the mid and the small caps. The large caps are, as yet, especially within the banking pack, the valuations are yet, within a reasonable benchmark. But I think overall, when you look at the markets, the broader markets, clearly valuations is one of the main concerns. And then when you get into an earnings season where you have a little bit of disappointment, you clearly see this as a reaction to that. So I just think that, look, any sort of correction is welcome, because I think there is enough liquidity on the sidelines which is looking to invest into India, waiting for any sort of correction. So I think we will get these bull market corrections from time to time, reflecting fundamentals and reflecting earnings disappointment. It's not unusual. But I think, I don't see this turning into a very substantial correction. Even if the correction is anywhere around 5 to 6%, it's very much par for the course and is welcome.
Nitin, you partially addressed my question. I'm looking at FY25 price to earnings ratio for the Nifty, with the way it stands, it's a little shy of the 20 times mark. Now, we're looking at a previous 5-year average, and that's at around 25 times as well. You did mention to a certain extent that there could potentially be more value in large caps as compared to mid caps and small caps. And you also partially addressed, there could be value in banks. Beyond banks, where else do you see a potential upside from here on?
So I think, when you look beyond banks, an area is consumer discretionary, especially the auto sector, considering the kind of strong growth numbers that we're seeing. So whether it's autos, auto anchs, whether it's healthcare and pharma, I think those are some of the areas where the comfort is a lot more higher. In terms of the industrials, I think clearly the kind of valuations that the industrials are trading at is sort of reflecting their numbers many years out. So and even a slight disappointment can result in sharp cuts. But I think for us, the sectors which look quite attractive is clearly financials, consumer discretionary pack, and pharma.
Then at this stage, your approach to the markets would be sector-specific or market cap-focused? Because what we've really heard and seen is that the risk-reward is far greater now in the large cap space.
So, you're right out there. But, it would be more, I would say, when we look at the market, we look at it more from a sector perspective and a bottom-up perspective. And when we are creating portfolios, and it just coincidentally happens, just to address your questions further, that a lot of that is today visible in the large cap space more than the mid and small cap space. However, we do not really start with the capitalization and go downwards. It's rather capitalization is emerging as a result of the growth value matrix actually falling in their favor.
So, Nitin, if I had to ask you, your base case returns in the Nifty, what would the expectation be for 2024 calendar year?
So when you look at calendar year 2024, we were looking at a number anywhere around 22,400, on the Nifty. So so basically you're talking of roughly around 900, 1,000 points from here. So that's about 4 or 5% in a base case.
Right, Nitin. So you did suggest that when it comes to the broader markets, there isn't as much value. However, a substantial amount of your returns are also made through that. I want to talk about pockets where there could potentially be some value going ahead. Where do you see opportunities here?
So just as I alluded to earlier, I think we just discussed that in terms of when you look at pockets, financials is one clear pocket which should do well. I think as we start seeing rate cuts, we will start seeing the larger banks starting to benefit out there. We do see the auto consumption discretionary run continuing, and you will see real estate as a part of that also doing well. Then, bottom up, there will be selected opportunities in sectors such as cement, which will be proxies and are better quality businesses to play out the whole infrastructure theme, and pharma.
Right. Nitin, what are you doing with portfolios at this stage? I know September, October, people were talking about, and investors were sitting on the sidelines anticipating a correction. None of that happened. There potentially could have been some dry powder lying around for investors as whole. At this stage, would you be taking a cash call at all or fully invested?
So we have a bit of cash in our portfolios, and for new investors coming in, we are asking them to stagger their investments over a 4 or 5 month period. In fact, in our recent AIF that we launched, we are taking money in 3 tranches. So to sort of meet the challenge that could be posed possibly by the elections and the volatility that could accompany that time period. So we are asking a staggering. The other thing that we're doing is we're looking at companies and businesses where we see a huge amount of visibility as far as their earnings growth is concerned. So, for example, if you take the travel sector, right, aviation, travel, and hotels, you see a huge amount of visibility because supply will take some time to fill up. And therein, the risk to earnings is far lower than a lot of other sectors. And I think post this correction that we've seen in financials, I think again, at least as far as the larger banks are concerned, there is this whole correction that has taken place post yesterday's result of the bellwether, which is making them also look very attractive, and their earnings visibility also is pretty high. So what typically happens in these markets is that even if you have a correction, where stocks have very high earnings visibility, they tend to bounce back far faster.
In fact, Nitin, that brings me to my next question. HDFC Bank, I mean, it's gotten those numbers, sure, weren't very impressive, but they were not as disappointing either to deserve the kind of sell-off the stock saw on the ADR, then locally. Let's also not forget that 50% of the bank is owned by foreign institutions, right, or FPIs in that sense. This morning, it is being able to find its feet, a little bit of support coming in at 1,500. Do you think at this stage, at this juncture, the risk reward is very clearly in favor of HDFC Bank? And, the stock, it's only a matter of time, I'd imagine, right?
So I think, you're right. And if you see this whole banking pack, there have been various analysts who have put out reports talking about the fact that how banking has never been cheaper over its history than it is today. Especially considering how clean the bank balance sheets have become from an NPA perspective, from a capital adequacy perspective, how healthy they are. But because of over-ownership on part of FPIs and who've generally been in a risk-off mode most of last year given global developments, and the fact that bond yields in the US have been very attractive and have sort of been an alternative to moving to emerging markets, you have seen this sell-off. So I think the over-ownership issue has plagued the Indian banking sector while fundamentals have got better. And I think, post yesterday's correction, obviously, the valuations are looking even more attractive. I just think from a long-term perspective, if you look at how this sector is poised, and it's one of the key elements of growth in the economy. So if you're betting on growth in other sectors, you cannot not be betting on growth in the banking sector, which is a proxy for that. So I just think that, once you see this, and look, this is the most liquid sector. So hence, when you have sell-offs, it's the first place which faces pressure. And so I just think that, and that's one of the reasons, if you look at it even last year, I'm sorry for the little long answer to your question, but you will see the second tier and third tier banks have actually done better than the top tier banks because they are not as heavily owned by foreign institutional investors as the top tier banks. But I just think that the valuation case is becoming more and more pronounced in their favor. And I think if someone wants to take a longer term view, I think there is clearly money at attractive valuation sitting there today.
You know what, moving beyond just the banks, a quiet mover in terms of sectorals has been pharma as well over the course of the last few quarters. Nitin, what is your thesis here and why are you positive on this particular sector?
So look, I think if you look at the pharma sector, there are two plays here. One is the domestic play, which is again a play on consumption, wherein you've seen a big rally in hospitals. I think it's we are clearly yet a long way to go as far as hospital growth is concerned and quality hospital growth is concerned. So you will continue to see the sector remaining buoyant. And, these earnings have a great amount of visibility. We've seen that sector see a first round of run-up. You've seen domestic pharma do very well and trade at valuations. So, there's actually been an inversion. There was a point of time where generic pharma and companies with US exposure used to trade at premium to domestic pharma. Now it's sort of turned around. You're seeing domestic pharma doing well because visibility of business and pricing pressures are much lesser out here, and hence you're seeing them enjoy higher return profiles. However, the interesting thing now is that generic pharma also is starting to pick up on that because there is a belief that the prices in the US have bottomed out. There was a period of time where there was immense pricing pressure out there and led by the fact that the distributors out there were more powerful and were able to dictate terms, but I think that bottoming out has happened. There is a shortage of a few drugs, and so you're starting to see generic pharma come back. And valuations are, again, not very, very expensive, and given the kind of companies and high-quality businesses that exist out there.
Then talking about, and I'm so glad you brought this up, right? Because domestic play in the pharma space is clearly or should be demanding a premium as opposed to the export-focused pharma companies, even though the pricing pressure is off in the US. Talking about exports, talk to me about IT. If you were a tech investor last week, you'd be laughing your way to the bank. Flat to weak numbers, in my opinion. Margins should have improved, but that could be on back of operational efficiency, which usually happens in a slowdown economy. Go down to calendar year 2022, when IT was doing well, margins were actually shrinking. Attrition was rising. So when we look at what's happening currently, it makes me a little concerned. But the market was quite pleased from whatever they saw. How do you feel about IT? Do you feel like we are getting ahead of ourselves? There is still no clarity, no trajectory of growth coming back to historical levels?
So, you're absolutely right. If you look at the commentary that emanates from all the IT companies, there, in the short term, at least, there doesn't seem to be great visibility. And, and we really don't know what is going to happen to the US economy, whether it's going to be a soft landing, hard landing. I think all the wise men in the world have projected different scenarios and have been proved wrong at different points of time. But clearly, the important thing is not that IT spending is not going to come. It's just that it's getting deferred. And, most companies, if you're not sure of the visibility on your business a few quarters down the road, would rather tend to hold this. So given that scenario, and the fact that actually, in some companies, the earnings growth was tepid, most people guided margins down. I think, again, there is a premature expectation being built that, the worst is over and, things will pick up 6 months down the road in the IT companies, leaving actually virtually no scope for disappointment. So I would be a little wary, at least in the near term, as far as investing in the IT companies is concerned.
I also want your view on the real estate pack, because we have seen that one as potentially one of the biggest movers over the course of the last 12 months. That said, valuations at this point of time are factoring in some staggering numbers even going ahead. Leaving aside the fact that they don't have inventory right now and they still have upcoming projects, and also the way things are panning out on ground. What is your view on real estate space? You also made a mention of ancillaries around real estate. If you could take us through your view here.
Sure. So, real estate is seeing a sort of consolidation where you're seeing the organized players actually gaining market share at the cost of unorganized players. And that trend is going to continue, especially post-implementation of RERA that has happened. Also, the building of some of these players into brands. So, once an announcement is made by a branded real estate player, there is a degree of comfort which is facing, which comes to investors who are sort of investing in property, is also building a big premium for some of these companies. So I think, given the fact that inventory is low, as you alluded to earlier, the balance sheet position of a lot of these people is far more healthier than it has ever been. And don't forget, we are at peak of interest rate cycles in terms of mortgages. So if interest rates start coming off, as is the expectation, maybe 6 months down the road, you will see mortgage rates becoming even more attractive. So I think real estate has yet legs to go. It's coming off. It's just about 2 or 3 years into a cycle which has just emanated after a very long, almost a decadal down cycle. So it yet has legs to go and should continue to do well. In terms of the ancillaries that feed onto the real estate companies, so whether it's cement, whether it's building materials such as ceramics, tiles, plywood, I think, or even structural steel, I think all of them will do well. In some of these sectors, valuations have run up quite a bit, in fact, and they trade at the late 20s type of valuation if one looks at it on early, FY 25 basis. And so, I think the comfort out there is a little lesser. And one has to be very stock specific when playing that.
Lastly, Nitin, you talked about how you're looking to identify good quality companies, how much of your portfolio stocks are dependent on government orders? So I want to talk to you about sectors like railway, defense. These have been the theme all through 2023, and all these counters have ran up on order wins, not on execution. Would you, and given the expectation of policy continuity, would this space still be something that would find a way to your portfolio?
So, honestly, our approach is a little more focused on cash flows and, working capital and profitability. So, while we believe that in the short term, in the run-up, in the next quarter or so, you will see a cooling off of order flows because of election restrictions that would come. But I think if we see the present dispensation coming back to power, you will see some amount of continuation as far as the order book is concerned. There is a hope that the private sector also starts jumping into the party because most private sector companies are running at 75% plus capacity utilization, and there is an expectation post elections for them to start announcing their investment plans. For us, this is always a very tricky situation. So while there is a lot of momentum today that is being played out in some of these companies, we don't see valuations commensurate. We see valuations are elevated relative to the profitability. So I think we are paying a price for earnings way out, almost 3 or 4 years, just because we have order book visibility. But we have seen that execution can be a challenge. There can be delays. There could be, in some cases, the land acquisition issues, payment issues. So we are not very comfortable with some of the valuations that these companies are trading at. And we would rather err on the side of caution while we continue to remain positive on the whole capex infrastructure story. We think valuations are something which don't give us too much comfort.
Cautiously optimistic. Well, thank you, Nitin. I'd love to talk to you longer, but we're completely out of time. Hopefully, we'll catch you for a longer conversation sometime soon.
Thank you.
In the meantime, there is a little bit of recovery on the street. The Nifty is showing some signs of recovery. Bank Nifty also not doing too badly. In fact, HDFC Bank, if I can quickly pull that up, should give me a sense of what's happening on the stock itself. But the biggest loser this morning is LTMI. 1,500 odd is what we have HDFC Bank at. We'll take a break. We'll come back. We'll talk about a relatively small company, but very exciting prospects. It's Ganesh Benzoplast. Rishi, Ramesh, Pilani will join us and tell us about what they plan to do with all the money that they're raising through marquee investors. Welcome back. The markets are looking weak. In the red, Bank Nifty is also looking bad. LTI Mindtree is a top loser on the index. But we have with us a company that joins us in conversation. Exciting prospects. Rishi, Ramesh, Pilani, Chairman and Managing Director of Ganesh Benzoplas, joins us today. Hi, Rishi. Good morning. Thanks for joining us. Rishi, of course, there's been a little bit of news flow with Ganesh Benzoplas. You've also had Sumit, in fact, Malabar Investments, come in and, get on the company, and of course infusing about 27 odd crores is what I believe. But the latest news flow is your joint venture where you are looking to develop LPG onshore import terminal at JNPT. Talk us through this. What does it entail? When will it become revenue accretive? What are the timelines, the investments? Just bring us up to speed.
Yes, so BWLPG, which is an Oslo-listed company, and they are headquartered also in Singapore. They are one of the world's largest carriers of LPG in the world, and also the largest carrier of LPG into India. So we have tied up with them and Confidence Petroleum, which is the largest private distributor of LPG in India, to sort of have this synergy of supply chain, storage, and distribution of LPG, which is a unique concept which we have introduced for the first time. The advantage that we are trying to get out of this terminal, that anyhow JNPT is one of the best locations to work with in India, and we want to create a terminal of a size that can handle the biggest ships, which are known as VLGCs at a go. So it will not only add cost benefit savings for the entire supply chain, but it would also help to penetrate the Indian LPG market faster. The total investment envisaged in this is approximately anywhere between 600 to 700 crores. It will be a mix of debt and equity, and we are already committed with our share of the equity along with our partners. The infusions have started, and we are in the process of closing the debt and the final approvals.
Rishi, break this down to me. What is your commitment in terms of funds that you're going to contribute to the JV? Is it a 50-50 split?
Yeah, in terms of voting shares, yes. The voting shares are split 50-50, but the economic interest is split 45 for Ganesh Benzoplas through its subsidiary and 55 for the other two partners together. The project is expected to start into full construction mode, though partly the fire systems and all are already been installed. It's full LPG tank construction and pipeline construction is expected to start in the second quarter of the calendar year of this year, and about 2 to 2.5 years of finish time.
Right. Rishi, so while the economics you said is about 45 odd %, I know Malabar is coming in 27 odd crores. Promoters, you have contributed or committed about 3 odd crores. That brings us to about 30 odd crores. The balance, what is that amount? A, and B, is that going to be completely done through debt, or some more equity infusion can be expected?
No, so see, if you take a typical project cost of 600 crores for right now, so you would, we as partners would infuse about 30% of the equity, and 70% would be through a debt financing. But the unique part about the project is that our partners have also given us an assured revenue for the next 15 years through the in this project, which sort of really makes this a very, very low risk venture for GBL.
Right. Rishi, this is very exciting, and of course we don't have too much time, but I want to quickly get in 2 small questions wrapped into one. You said your partner has given you assurance of revenue for the next 15 years. What is the quantum of that minimum guarantee of sorts? And also margins. Now, this is a very high margin business. When will this start contributing to your blended margins, and what can we expect from you? Let's talk calendar year, right? Because I know there's also earnings down the corner, but over the next couple of quarters, what can we expect on your margins, and what is the assurance of revenue from your partners for the next 15 years? So what's the visibility there?
So the assurance of revenue from our partners is close to about 1,200 crores over the next 15 years in this project. And we expect that sometime in the first or second quarter of FY 26-27 is when we will start seeing the revenues coming out of this project. And you're right, this typically we would expect anywhere between 70 to 80% EBITDA margins out of a LPG project.
Very exciting, Rishi. I'll try and connect with you offline to get a better understanding of Benzoplast. It's interesting. The markets are having a down day, but your stock is actually still looking pretty good in positive territory. I know you don't probably track all this, but still exciting for the viewers. With that, that's all the time we have with Rishi. Thanks for joining. And with that, it's also a wrap on India Market Open. Thanks for watching. I caught up with Unmesh Sharma, Head of Institutional Equities at HDFC Securities. Listen to what he has to say as he talks about the market showing signs of topping up.